NVIDIA is down a lot in the last 18 months. And of course, as a value investor, this always piques my interest. It's a great place to start to see, is this company in value territory where I can buy it, where price and value are disconnected? So let's check it out on our software. I'm going to type in NVIDIA, NVDA. Now, NVIDIA makes graphics chips and chips like that for a lot of gaming computers. Obviously, it's a fast-growing industry with a lot of growth potential. I believe I read an article in which the industry is expected to grow at a 12 to 13% clip over the next 10 years. So a company like NVIDIA that makes very high quality graphics cards can really kill it in this market. But remember, you might be asking, well, why is it down from a 52-week high of 350 down to 126 and currently at 132? Because it's possible to overpay for value. So if you're new to this channel, I'm Paul. I've been teaching value investing for over 10 years and the last few years on YouTube. Now, just because I or anyone else has a YouTube channel does not make us an expert. However, I guarantee that if you watch 4 or 5 of my videos, you'll walk away understanding money a little bit better, understanding investing a little bit better, but also walk away saying, hey, this guy, I kind of get it. His process does make sense. You might not agree with everything, but the process makes sense. I look at every investment as the present value of all future cash flow. It's determining that future cash flow. That's the art of investing. So to NVIDIA, let's use our 8-pillar process to understand the company. So pillar number 1, we want the 5-year PE ratio for the company to be under 22.5. So right here on our main page, we scroll down a little bit and the 5-year PE is 65. That's an X. That's a lot higher than we like it. Does that mean you should run for the hills and not buy NVIDIA? Not so fast. Just means it's expensive. Now, if a company can grow like crazy or have a high return on the capital in the business, it might justify that. We don't know yet until we use our stock analyzer tool that will allow us to assess that. So pillar number 2 is that second part. What is the 5-year return on invested capital? We want it greater than 9%. So right here to the right, boom, 12.8%. So this tells me that this company does a good job of reinvesting the capital in its business. And in all likelihood, their weighted average cost of capital is way less than 12.8, which means they are making economic profit for their investors as they reinvest the capital in the business. So pillar number 3, very simple, revenue growth. That's all I care about. Last 5 years, has there been revenue growth? So I go to our income statement and I look at 5 years ago, 11.88, and last year, 30 billion. Now, there was growth here, but I want you guys to remember, this growth was sudden and huge. Because remember, we had a chip shortage, everybody was buying lots of stuff. So I do look at this going, okay, is this level sustainable? And if you think I'm wrong on this, I want you to remember that if this was a sudden drop, I would wonder, is this a sustainable drop? Is this a permanent drop? Or is this a temporary one? Just like airlines. Airlines went from $30 billion in revenue to $500 million in 1 year because of COVID. Was that drop a permanent drop? No. So the same thing has to go when it's going up. Is it a permanent plateau? And that's what we don't know, and that's what we'll find out. Pillar number 4, we want net income growth over the last 5 years. 4.3 to 7.7 with an average of 5 over the last 5 years. But again, same thing, drop, increase, skyrocket, skyrocket. Is this a permanent jump? That we don't know. And we'll find out, and I'll show you later how we're going to use our stock analyzer tool to determine if that's more permanent or not. Pillar number 5. Now, guys, this is a silent killer in investing. I want to look at shares outstanding. Are shares outstanding increasing or decreasing? Not many people will ever talk about this. This is one of the big differentiators between me and other people out there. I want to make sure that this company isn't punishing me as a shareholder by diluting me by issuing more and more shares. So I scroll to the bottom and I want to see a drop in shares. So I go to the end of the 6th year, 2.39, and last year, 2.5. So they are diluting me a little bit. However, I'm going to justify this a little bit for NVIDIA, and here's why. 1, it's not a huge jump. 5% over 5 years, big deal. But the stock was also very, very, very expensive. It was $350 a share, now it's $160 or whatever. I like the fact they're like, listen, We either take on debt or we issue shares to fund the business. I'd rather issue expensive shares and give all the people who want those expensive shares that money. So I'm not as upset about this as other people would be or should be. Pillar number 6 has to do with long-term debt. The question is the long-term debt something they can manage? So I've done something very simple. My method of looking at it is I go back to the main page and look at their 5-year average free cash flow. It's $4.9 billion. I multiply it by 5. So let's call it $24.5 billion. I want their long-term liabilities to be under $24.5 billion. So how do I find that out? I go in our software to the balance sheet. I scroll all the way to the bottom right here. Long-term liabilities. Look at that, guys. $12 billion. That's half of where we want it to be. That is awesome. And debt works for a company the same way it works for you. A company with more and more debt will have harder times when there are tough times. And when interest rates adjust higher, as they have been, it's going to cost companies with a lot more debt a lot more money to operate. So just remember that going forward. Now, pillars 7 and 8, and there's been a lot of math here, and I'll show you the shortcut here shortly, but pillars 7 and 8 have to do with free cash flow. So what is free cash flow? You hear it all the time, but nobody explains it. Free cash flow is cash from operations less your capital expenditures. You can do one of 5 things with free cash flow. You can buy back shares, pay down debt, pay dividends, invest back in yourself, or make acquisitions. You can do any 5, one of them, any combination you want. The point is, it's the lifeblood of the business. And this is the metric I look at more than earnings because free cash flow is a harder number to manipulate than earnings. So we go to our cash flow statement and we scroll to the middle. And like I said, cash from operations, less your capital expenditures, but your loving Uncle Paul actually added this line right here. Boom. 4.14 to 6.26. Check mark there. So there is growth. And our final metric, just like the PE, we want to price the free cash flow of under 22.5. So since we don't have it labeled here, we take that 4.9 billion, we multiply it by 22.5. Now just to make it easy, we'll call it 5 billion. So 5 times 22.5 is $112.5 billion, I believe. So 112.5. So we want the market cap for NVIDIA to be under 112.5 billion. So we go back to our main page here. We scroll down, and here's the market cap, 330 billion. So that's an X. And I told you there was a shortcut for all this math, and here it is, our wonderful tab here. So, guys, apart from this shares outstanding, which doesn't really bother me as much, it's all about value. The 5-year PE and the 5-year price of free cash flow are very similar, which we like to see. So it's just about saying, okay, this company seems expensive. These are very high multiples. But again, they have a high ROIC, and they're in an industry that has a lot of growth potential. So let's see what analysts are saying on our software. Our software pulls in analysts, 47 analysts from out there. They're not the only analysts out there, so go do more research on finding other ones. But these are some analysts out there. And look at this. Their earnings per share is expected to drop next year and then grow back up again at very high rates of growth. So they're expected to over double their profit in the next 5 years. And now for their revenue down here below, boy, according to analysts, they've hit a permanent plateau. Look at this. There is no drop here that's going on in revenue. Okay. Now, what does that mean? Well, these are all just estimations. Every investment is the present value of all future cash flow, like I said earlier. And all we can do is make assessments on the future and then determine, based on those assessments and assumptions, what is the stock worth to us today? This is exactly why we created the stock analyzer tool. So before I do this, I want you to remember, value investing is a very, very lonely road. And this is precisely why we created the Everything Money community. This community up here has thousands of people in there who at some point said, I don't think the investing world is right, and I believe that I have a different view. And they got in this community to talk about their investments. We're about to go put some assumptions here. Now, how do you make your assumptions? There's many ways to do it. Look at analyst expectations, go in there and read research reports, or very simply, go into the EM community. Have a conversation in there about NVIDIA. I'm sure it's a hot topic in there, and you can actually search NVDA, hit enter, and it'll show you the exact location of where people are talking about NVIDIA. Research is hard on your own, so use the community to sit here and get research done more efficiently. I love doing it. It's awesome. But this isn't the only reason to use this. This entire software here is what you get when you join this community. It's less than $1 per day. It gives you everything you've seen here, 30 years of financial data, stock analyzer tool, retirement calculator, so many other tools that haven't existed. And best of all, also watch list. When you do a stock and put it in the stock analyzer tool, you can decide what price that the software and an email will tell you when that price is hit. We also do exclusive content every single day where Mo and I do content just for our users. All of this, guys, is only $1 per day. It's a no-brainer. If you want to do this, go to everythingmoney.com or patreon.com/everythingmoney for our international users. It's a no-brainer. It will really change the way you look at investing. So let's go look at these revenue growth numbers. Now, first off, I'm doing a 10-year analysis on the stock right here. And I'm showing the 1, 5, and 10-year numbers. So in the last 10 years, revenue growth has been 24% a year. Last 5 years was 25.8. Last year was 35.8. So it was getting faster and faster. Now, if you remember, back here at analyst estimates, the revenue growth was going to be in the, let's call it low to mid double digits. That's only on 5 years. So on a 10-year number, I got to be a little more conservative because as the company gets bigger and bigger, it's harder to grow at faster rates. So on the high end, I'm going to put 15%. I'll still put 15% in. I'm still going to go high, 15% in 10 years. Middle one, I'm going to go put in 11%. Low side, I'm going to put in 7%. Because I think to myself, okay, they should be able to grow 7% because they make a high quality graphics card. They're very well known. I'm comfortable saying 7% growth, which over a 10-year period is still doubling their revenue. Now, profit margin. Now, guys, one thing I want you to remember, look at this profit margin. They had a killer year and their profit margin stayed the same over the last 10 years. That makes me feel somewhat good that their profit margins are probably pretty consistent. Now, if you look right here, their free cash flow fell, which I'm okay with because they might have invested back in more growth or something like that. So for profit margin, I'm going to assume that they drop a little bit because as economies go into recessions, things like that, profit margins will shrink. As interest rates go up, profit margins will shrink. So I'm going to go with 23, 25, and 27%. Free cash flow, I'm actually going to do exactly the same thing. Now, PE and price of free cash flow. Now, this is asking for what will the PE be in 10 years at the end of my analysis? As the company gets bigger and bigger, it's harder to justify a big PE because in my opinion, a large PE is because of growth potential and return on invested capital or moat. In this situation, they have a pretty good return on invested capital of over 12%. They have, I think, a moat in terms of graphics cards. If you ask people the number one player in graphics card who are in the know, I think NVIDIA is popping up there. So I like that. But again, over historical times, 15 is about the historical average for the market and for individual stocks. So I'm going to go with 14, 16, and 18. And even the 18 is kind of hard for me to swallow, but who knows? Maybe with the high return on invested capital, they're able to expand their business, do a little bit better, and really secure that moat even further. Now, finally, my desired annual return. Guys, I'm very conservative here, more aggressive here, and very aggressive here. So if I can get 9 or 10% by dollar cost averaging into a low cost market-based ETF, my goal should be get a higher return here. And as I go up in my assumptions, I want to have a higher desired return because I want more margin of safety. So what I like to pick here, I'm going to go 12.5, 15, and 17.5% returns. This will give me the ample margin of safety that I feel that based on these numbers, if I'm able to buy for less than these numbers, I will do well. Now remember, if all these numbers are green, it doesn't mean go out and buy. It means get focused on the community, go do more research to figure out if these assumptions are correct. So I hit the analyze button and here's what we got. We got a low price of 44, a high price of 75, and a middle price of 60. Now, I have it on my watch list at 100, and the reason being is I want to start doing more research when it hits 100. That way I'm ready to buy when it hits somewhere in this area. So if you like this video, it's absolutely important that you watch our next video about margin of safety because it'll really explain how that can make you a better investor and an investor that makes less mistakes. Thank you very much for your time, and please subscribe to the channel. The recent 12-year bull market has had very few interruptions. The biggest one was the pandemic.